morning, everyone. So thank you so much for joining us on this Saturday morning. So like today we are going to discuss about the sectoral investment opportunities. Just before that, a quick disclaimer that whatever the themes and the sectors and the ideas that we'll be discussing. So those are just for the educational purpose, and do your own research before investing in those ideas and themes. So starting with the webinar, so last 2 quarters have been quite turbulent for the Indian market. We have seen a lot of one of factors impacting the market. In fact, there has been a lot of geopolitical uh, tensions have been in the past. For example, starting with the tariff impact on the market, and then post that we had a skeletal situation with our neighbor, and that has led to some sort of selling into the market. And post that Israel-Iran war was again one of the key triggers for the market to consolidate. So so what we felt that investors were sitting on the sideline and were not ready to deploy, considering these geopolitical factors were having a larger role to play in the short term volatility. But we don't have to forget that India has been a very structural story. It has been a very strong structural story, and in the last month itself the country has crossed a $4 trillion mark. Now we are the fourth largest economy in the world, and we are on route to become become a $10 trillion economy in the next 8 odd years, right? So what we have achieved in the last 3 4 odd years, and what we are going to going to achieve in the next 7 8 odd years, it would be phenomenal for the market, right? So just to put things into perspective, like post independence we took nearly 60 years to add $1 trillion to the economy of $1 trillion of GDP to the economy. The next $1 trillion has come in the next 7 years, and post that the next $1 trillion has come in just 5 odd years. And the very recent, the last $1 trillion we have achieved in just 4 odd years, right? Post COVID. So in the next over the next 7 to 8 years, we'll be adding 300 to $500 billion to the economy. And considering that something which some companies which where the market cap is just in the range of $4 to $5 billion, so adding every year 400 to $500 billion to the economy is a huge boost and the growth prospect for those sort of companies, right? So there are a lot of emerging themes and ideas and the sunshine sectors which are there in the economy that my colleague will discuss with you in the later stages. But we don't have to just get too much bothered about the short term volatility which is there in the market, mainly coming from the geopolitical side. But as an investor, if we are investing our money for the next 5 6 10 years, right, so we have to align ourselves with the India structural story, and the prospect looks very promising from the current standpoint, right? So now moving forward, just to compare what our peers have done, when they have crossed that milestone, right? For example, currently we are at $2,500 per capita mark, and that's a very important sort of event for any economy. It's an inflection point for any economy when it moves from $2,000 per capita mark, as this is a period where we see consumption of discretionary item, consumption of lot of value added products to take a boost, right? So for example, when China crossed that $2,000 per capita mark, over the next 10 years the economy roughly grew by 3x. The same thing has happened with Indonesia between the period of 2008 to 18. When the economy crossed the $2,000 per capita mark, it has grown by 2.8x over the next 10 years, right? And if we look at the consumption pattern also, so mostly the consumption was the sector where the compounding has been in the rate of more than 10 to 12%, and it has taken a larger share of the overall growth. So for India also, we feel that over the next 10 years, over the period between 2021 to 2025, the economy should ideally triple in that time frame, and there will be a lot of sectors that will be coming out which will get the benefit of the increased discretionary consumption. For example, we have seen Tesla to come to the India. We have seen Apple to outsource the entire manufacturing to India, now moving away from China and looking to set up the base in India. So those sort of manufacturing marvels will also take place, and consumption of high ticket size item will also take place into the economy as we move higher up in the ladder of per capita income. Not to look at what the market impact is there when a country grows at a rate of more than 8 to 10%. So what we have seen with China, that the GDP compounded by 13% over the 10 years, but the market return has been way higher at around 15%. And similarly for Indonesia also, the market GDP has grown by 10.6% CAGR, but the index return has been higher at around 20 odd percent, the market returns. So we feel that, like, on a conservative side, if our GDP can grow in the range of 10 to 12% between a period of 2021 to 2031, the NSE 500 on a very conservative side, keeping in mind the high valuations and, like, all sort of factors at play, we feel that on a conservative scale, the decade could be in which, like, the NSE can deliver on the base case scenario 14% return to a bull case scenario of 18% CAGR return. So those are very good CAGR returns to be expected from the index. Obviously, there will be some sort of companies which are very big conglomerate which will deliver the returns lower than that, and then there will be smaller companies, new age companies, which will be delivering the return way higher than the index return. So as an investor, our endeavor is to find out those companies where the compounding is more than 20%, create a portfolio for our investors, our sort of investor base, and take advantage of the fact that we are in a high growing economy and we have a index which is also doing very well. So as to create a portfolio where, like, meaningful compounding of earnings can take place. So now to move on, just to have a look at, like, how the Indian household is there. So we always discuss about that the valuations are higher, and, like, the equities are overbought. But in reality, we are very underweight economy in terms of equity exposure, right? Both in terms of foreign as well as domestic. So for example, if we talk about the it seems like when we talk about the foreign ownership, right? So our ownership, our GDP contribution to the global economy is in the range of 3%. And if you look at the ownership that we have in terms of, like, the passive ETFs which are out there, so our ownership is roughly in the range of 1.5% to 3%, which is very minimal, right? Currently, as our GDP size will grow and as our contribution to the global growth will grow, then the GDP contribution by 2035 will be roughly in the range of 6% to the global economy. And then there will be a case where that there will be India dedicated funds that will be coming in. India will not be a basket case anymore. So we'll see some bit of more inflows that will be coming in. So in a base case scenario, what we feel is that over next 10 years, we will have a 5x sort of meaningful inflows coming from the FII side. In fact, over the next 10 to 12 years, we'll see a cumulative inflow of $1.5 trillion coming into the Indian markets. And that's a very huge number considering we are just at around 5 lakh crore of market capitalization. Now coming to the domestic front, right? So the domestically we have the equity ownership in the Indian household is just around 5%, right? Which is roughly around $500 billion. But if we talk about the developed markets, even for China, that number is in the range of 20 to 30%, right? For developed markets, it's way higher at around 40, 45, 50% as well. So over the next 5 years, as we'll see the increase sort of equity participation from the retail side, also more sort of formalization of the savings. So we can see some bit of higher contribution coming from the domestic household investments. And over the next 10 years, we can see that number to ideally double to 10%, and roughly the contribution of the equity investment to go up by 7 to 8x over the next 10 years. So those are the steady inflows that will be coming to the market irrespective of the volatile FII inflow that we are getting. And those will be the trigger point for the market to maintain its sort of buoyant up move that we have seen in the last 3-4 years. Now, Prabhu, if you can move to the next slide, please. Yeah. So that has been the point of contention that the FII selling has been the initial trigger point, which has led to the fall in the Indian markets. In fact, in the last 9 odd months, we have seen cumulative outflow of 3 lakh crore from the Indian markets. That has started in the second half of last year and has continued in the first half of this financial year. Very, very rarely we have seen this phenomena to extend beyond a year. And if it take into account the past 15 years of data that we have, so roughly, post that outflow, post that low ownership of around 15-16%, normally FII turns a buyers, and when they turn a buyer, combine that with the total inflow that we are getting into the Indian market through SIP inflow, through the provident funds that we are getting, right? So will be a case where we'll be seeing net inflow into the market, and that will be again a case for excess liquidity driving the market up, right? Considering we have the support of earnings as well. So just to take into point, then Prabhu, you can just move to the next slide, please. take into point the returns that we have delivered so far. So the first half of the year has been the lackluster for the Indian markets, right? Globally, we have seen markets like Korean markets, German markets, in fact, the Chinese market also, Brazilian. So all the developed market and the emerging markets have continued to perform well, right? It's just that the Indian markets, which is consolidating in the range, and finally it has given given an up move over the last 2 3 odd months. So last year there was a lot of discussion happening that India is a very expensive market considering global peers. That sort of premium that India used to have over the emerging market as well as the global market, that has sufficiently come down, right? And coupled with the fact that we are a high ROE market, we are a high growth market, GDP is at around 7.4%, which is unparalleled, and we are a sweet spot of growth as well as corporate governance. So it could be a situation that our risk premium to the global market as well as the emerging market will continue to go higher in the second half, and so on and so forth. So somebody who is coming into the market for a very with a not so long time horizon of 10 years, but let's say time horizon of 3 to 4 years. So considering that we have underperformed the global rally this time, it could be an ideal point to put money into the market and be on the right side of it. Prabhu, you can just move to the next slide, please. Yeah. The other trigger for the markets to rally is that we have seen the US dollar index to come at the level of 97, right? And it is at a 3 year old, 3 year, it's at a 3 year at lower level, which we are currently seeing. And historically, what we have seen over the last 10 years, that whenever the dollar index has come down, it's a cue for the emerging markets to rally from there. And it's a very good trigger point for emerging markets to be net foreign flow positive. And this could be a case this time as well, that emerging markets will continue to trade higher. We have seen already happening with China, Brazilian market, and the other emerging markets, right? So since India is also part of the emerging market basket, if the emerging market continues to do well, it will continue to receive flows from the global investors. And since India is also a part of the emerging market, it will also be benefit of that, right? So overall, the moot point is that the trigger point for the market fall was the exodus of the FII money from the market. That is set to reverse considering 2 or 3 odd factors. Earnings are expected to be rebounded in the first quarter. Trade tariffs and the situations are again 9 July is the deadline. We are expected to reach an interim sort of consensus on that with the US government. And the third is that the dollar index is kind of weaker. The rupee we have seen to move back from 87 to 85 or 84. So that sort of along with the lower crude prices will give some sort of stability to the market, and we'll see we will again be a net FII positive for the year. So those are the key trigger points to keep in mind, that the market has been kept in check because of the FII outflow that will not be the factor going forward, and there will be some sort of reversal that will be seen. Now, Prabhu, if you can just move to the next slide, please. Yeah. And the other important trigger for the market that we are all waiting for last 1.5 2 odd years is that the Fed rate cut. So it has happened in the last year, but again, follow up on that Fed rate cut has not actually played out, right? And there has been a valid point that the tariff barriers that are imposed by US government is inflationary. But nevertheless, the dot plot is suggesting that there will be at least 0.5 to 1% rate cut that will be happening in the September or the follow-on meetings that the Fed will be having, right? So in the last quarters, there will be some bit of rate cut. And historically, what we have seen is that whenever there is a rate cut scenario, market has typically rallied on an average of 15%. So it has rallied more than that as well in the past. For example, in August 84, 81 or 88, the market has rallied in the range of around 18, 19 or 25%. But keeping in mind the average sort of return that we can expect when there is a rate cut scenario is it will lead to a trigger on the upside for the intrinsic value. So that's in the range of 14 to 15% as the cost of equity goes down. So that's again one of the triggers for the market to unfold, right? So we are again sort of buoyant, we are optimistic on that the rate cut will finally follow through in this year, and that will be a positive for the specific set of stocks which are high quality, high growth, for them to rally, right? So that's again one of the trigger to be one should watch out for going forward. Yeah, Prabhu, if you can just move to the next slide, please. Now coming to the important part, how we are placed on the valuation. So the valuations were quite comfortable when the market market fall has taken place in the months of February or March. But post that, we have seen the small cap index and the mid cap index to rally roughly in the range of 15 to 20%. All the indices are just 5 to 8% away from the all-time high levels. So the valuations are not so comfortable now. But if you look into account the peak valuation, so obviously the current valuations are trading at a discount to the peak valuations. For example, Nifty 50 peak valuation was in the last 5-7 odd years is roughly in the range of 29. Current valuation is around 21 or 22. The mid cap 50, the peak valuation was 36. Currently, it is in the range of 32x. And for the small cap, again, it was 36. Currently, we are trading at 28x. So having said that, there can be a case where we can see some bit of further re-rating of the multiples. But if the market has to sustain, the earnings has to come through. Last year has been a pretty low year for India Inc. in terms of earnings, what we have delivered, and there were valid reasons for that. There was very low capital expenditure that the government has done, and then again there was this physical and monetary tightening which was there. The interest rates were higher, so all those factors have led to some bit of tight growth scenario and the low earning scenario. But the situation is completely reversed now. The fiscal and the monetary policy are completely in sync, and the government, the RBI, what the RBI has done is sort of unprecedented. So in the month of September last year, the system was at around 2.5 lakh crore of deficit, and this year now, if you take into account the OMO refueling that the RBI has done. So we are currently sitting at roughly around, and the rate cuts that the RBI has done. So we are currently sitting at around 10 lakh crore of excess liquidity into the system, and that's very conducive for high double digit growth of credit into the economy, and also that will translate to the earnings growth as well going forward. And coupled to the fact that the last year we have a very low growth, so this year we will be starting the year on a very low growth base, so that will again be add up to the overall high growth for the year. So those are the factors which will be supportive of the market in terms of earnings growth and the valuation that we go forward. Prabhu, if you can just move to the next slide, please. Yeah, and again, this is a very important slide. We always take into account the Nifty in terms of historical parlance. But if we study the data for the last 17, 18 odd years since 2007, so the 10-year rolling average trailing Nifty P is always inching higher, right? For example, it was at around 14. The 10-year average P of the Nifty was around 14 in 2007. But if you look at FY25, the 10-year average number is 23, and that number will continue to inch higher, right? So if we anchor ourselves to the valuation number on a trailing basis, it means that in case the growth will be there, the market premium should be the overall market premium should be higher than the historical valuation that we have commanded. So going forward, we expect that the 10-year average trailing Nifty P to continue to inch up higher as new sectors will come up. For example, one important thing that has happened in the mid cap index as well as the small cap index, that in the 2022, 2023 and post that also a lot of new age IPOs are coming in, and these new age IPOs have a very high growth rate, but they also have a very punchy valuation. And as on when these companies become part of the index, they take the index P higher along with that, right? So to compare that higher P with respect to the the low trailing P is not the right framework. Rather, we have to normalize the numbers. And if we don't normalize, we'll always be this Nifty P number will continue to inch higher. In fact, this is true for the mid caps and the small caps as well. So considering that scenario like we are currently in, the valuations are kind of comfortable. But having said that, for markets to move, the earnings have to support going forward. If the earnings will not be there, it will be very difficult for market to sustain. So that's one of the risks that we see in the market currently. Now moving forward, Prabhu, if you can just move to the next slide. One of the factors that's again is very coming out very strongly for the India Inc. is that whatever the post-COVID restructuring that the companies have done, they have deleveraged the business balance sheet, and the margins have become more improved for the India Inc. So what we are seeing is that the profit to GDP ratio has been in uptrend cycle, and what the number has been for the year 2025, it's around 4.7%. The last time we have seen such numbers were around 2007 2008, right? So we are clearly in the up cycle. But what happened post 2008 was there was a sudden decline, and there was a lot of factors, like there were a lot of infra-related companies that has gone into bust, and then there was again an NPA cycle that banking sector has to go through. So fortunately, this time the banking is in a very premium space. The banking cycle, the NPAs and gross NPAs are well in control. The net interest margins are uh, well in control by the banks this time. And also, if you look at the balance sheet of the India Inc. So the companies are more delivered now. The companies which are part of the index now are more high growth companies as against 2007-8 cycle. So last time it peaked at around 5.2% in 2008. This time we expect that cycle to elongate a bit further for the next 4 5 odd years, and this will be a huge boost, and it will be again be a key trigger for the Indian valuation to remain punchy in the short to medium term. Right, so that will keep the valuations elevated for the India Inc. Ravi, if you can just move to the next slide. Now, coming to the final discussion on the economy side. So, what we have seen in the last 3 4 odd months has been quite remarkable in terms of the turnaround of the economy. For example, the CPI inflation is at a 6 or 7 year low at around 2.8%, and that gives enough room to the RBI to cut the rate. For example, we have seen the new RBI governor to cut the rate by 1% in just a odd span of 2 or 3 odd months, right? So because of the comfort in the inflation number that we are having, right? So that gives a leeway to the RBI to cut the rates, and this is again a very good sign for the economy that we are finally stabilizing in a low inflation environment, and there will be more support to the government to do liquidity financing to the overall economy. In fact, the growth rate for the GDP, which is a byproduct of overall liquidity scenario, right? So we have seen a sharp up move in the month of March. So, for example, that the growth plummeted in the Q2 of last financial year, but after that, we are seeing continuous uptrend in the GDP growth rate, and finally, we are at again 7.4% growth rate for the year for the last quarter. We'll continue to see 6.5 to 7% sort of growth rate for this financial year as well, and this is well supported by the GST collection that we are seeing into the economy. We have seen the GST collection to hit a high in the month of April, and then subsequently May also. And the Q1 numbers are again very encouraging, growing by 10% or so for the quarter over the last year. So we are again back to that growth rate of double-digit growth rate for the quarterly run rate for the GST. It shows that the economy is in expansionary mode, and we are well supported by both the MSCI as well as the larger players into the market. And the one thing that has happened for us is that current account deficit has turned net positive, and we are at around $3.5 billion net positive for the quarter. So it means that overall the economy, which was struggling in the last quarter, has come back, rebounded, and whatever the efforts being put by both the government as well as the RBI is not appreciated well by the markets. We have again the markets are have some short-term biases, and because of the recent geopolitical events that has taken place, we are again not able to move past our previous highs, but the economy is reflecting into the pink of health, and we feel that going forward there could be a turnaround for the market as well, and we have some good themes that we can bank on, that my colleague Vijay will discuss with you in detail. So over to you, Vijay, now. Thank you.
Yeah, thank you, Prabhat. Now we'll move on to the next section, which is emerging themes. So before we move that, Prabhu, we can move to the next slide here. So as we are traveling towards the $10 trillion mark, so there are few key drivers which will play a major role when we move towards the 10 trillion mark. So some of them we have tried to capture on this slide. First is the government capex, PLI scheme, expansionary monetary and fiscal policies, energy transition, China plus one, financialization of savings, and rising per capita income. So all these themes, all these key drivers will lead to boom in multiple themes. And based on that, we have identified 6 themes that we will discuss in the subsequent section, which has higher probability of delivering above average industry growth. And also they will outperform in terms of the India GDP growth rate, also what is the relative other industries, and that will lead to the future multi-bagger creation. So now we will start with the first theme. So first theme is wealth management. So as India's GDP is going to climb up at a nominal GDP growth rate of around 10 to 11%, we will see substantial rise in the disposable income. And when there is a high rise in the disposable income, naturally people tend to accumulate surplus cash. And natural tendency is to spend some of the cash towards the consumer discretionary products, and some portion of it will go for the investment. And that is how the rise of need, let's say the rise of wealth management industry happens in the country which are turning from developing to developed side. So if we look at the Indian landscape, so currently, if you look at the wealth to GDP ratio, and if we compare with the one of the most developed economy in the world, which is US, so US is at 6.5x, India it is at 4.5x. If you look at the financial wealth, the percentage of wealth which is, let's say, invested or stored in the financial system is around 70% in the US side, and in India it's only 25%, so almost one third of the US side. And if you look at the money or the wealth that is professionally managed, so US has a high penetration of 75%, and India is at around 15%. Also, the Indian mutual fund industry penetration, if you look at, it's around 13 to 14%. And if you look compare with the global average, so global average is around 65%. So we can clearly see there is a huge under penetration when it comes to the wealth management industry. Of course, we recognize that this journey of, let's say, moving up from 15% to 75%, it will not happen in, let's say, 5 years or 10 years. It may take 2 to 3 decades, but this journey will be a quite rewarding one, because the nature of growth rate is quite predictable, and the track road, or let's say the roadway, is also very long. If you look at the current population, which is around 144 crore, so we have a huge runway for the growth in terms of the wealth management space. And one of the research which was conducted by Knight Frank, so if we look at the HNI population, so here we have taken HNI population, the people with more than $1 million net worth, which is around 8.5 crore in today's term. So in 2022, this mark was around 8 lakh, and we expect it to hit around 16.5 lakh, almost double in the 5 years of period, in terms of the financial years. So this is again a huge boost if we look at in terms of the wealth management industry. And if we dissect the wealth management industry's growth rate, so there are two components. So any wealth management business will have two levers of growth. First will be the growth which is coming from raising the new asset, and second growth will be the assets which are already deployed will go up with the market. So let's say a company has raised 10% new assets, and market has gone up around 15 to 14% in a particular year. So 24 to 25% kind of compounding can happen for a company which is operating in the wealth management space. And with that, we expect the wealth management space to at least triple in the next 5 years. Of course, this is a conservative estimate. If we see the more, let's say, the robust GDP growth and robust inflows from the domestic side as well, and also the equity participation increasing from the SIP inflows as well. So this can also go up to 4x in the next 5 years, because a lot of alternate products are also coming into the system, which will also increase the penetration. So in wealth management, we typically can forecast like this industry will have at least 20% growth rate. Of course, there will be some volatile period, because whenever there is market correction, the profit pool takes hit for the short period of time, as we have seen in the last 2 quarters. But on a general, if we look at the perspective of, let's say, investment horizon of, let's say, 5 to 10 years, so this theme is quite rewarding one, and it has potential to deliver 18 to 20% CAGR on the conservative side. Now we'll move on to the next thing. Prabhu, we can switch to the next slide. Yeah. So second theme is consumer discretionary. So as my colleague has highlighted, like we are at around $2,500 GDP per capita mark. And as we have studied the other developed economies, what we have observed, once this mark is crossed, so there is a natural push towards spending, natural push towards the consumer discretionary spending, what is the necessary spending, because now people have like more surplus cash to spend behind consumer discretionary products. And some of the themes, there are multiple themes actually in the consumer discretionary space, like electronic items or apparels, or even the, let's say, mobile phones or the experiential items, and also the luxury goods and all. But we typically like the two segment. One is the fashion retail, which is the apparel market, if we call it, and second is the jewelry space. We have picked this sub segment because of the two important factors. The first is the high growth rate, which is also the predictable and the consistent. And second is the total addressable market is quite large. So if we look at the fashion market, so in 2023, it was around 5.4 lakh crore, which is almost 5.5 lakh crore, and it is expected to grow at around 18% CAGR and reach around 106 lakh crore. So 10.6 lakh crore. So it will almost go up by 2x in the next 4 years. So this is a quite high growth rate. And let's say if one wants to play this theme, so we have to keep in mind like there are also the two levers of consumer discretionary growth. One is your SSSG growth, which is the same store sales growth. And second is the new store addition growth. So let's say any player who is working in the fashion retail space, the stores which are open for last 1 year or more, so those are considered the mature stores, and let's say they are growing at a 10%, and in the current year, let's say you have opened around 10% new stores, so you will essentially grow the revenue at a 20%. So anybody who wants to play this theme can identify such players who have the high SSSG, maybe 8 to 10% on the comfortable side, and the store addition of around 8 to 10%. So in a nutshell, this industry is growing around 18%. So a good executioner player in this industry can handsomely grow at around more than 20% growth rate for next 4 to 5 years, as we have highlighted. So this is the one segment of the consumer discretionary. The second segment is jewelry. So if you look at the jewelry market, so jewelry market can be valued in terms of, let's say, $84 billion. And if we have to value in terms of volume, so we have a jewelry, a gold total gold market is around 850 ton on annual consumption side. Out of that, 200 ton is basically the bullion or the gold coins, and 650 ton is your jewelry market. This 650 ton is converted into the $84 billion as of 2024. And if we look at the growth rate, which is projected, so it will grow at around 16% towards $145 billion mark from 2023 to 2028. So it is a quite predictable growth rate. But important thing to notice in jewelry space is the share of organized shift, which is captured in the next slide. So as we can see, so what we have done is we have tried to segment the overall jewelry market in terms of the organized share versus the unorganized portion. So earlier the organized share was around 10% in FY21, which has come down to almost from 90% to 62% unorganized share, and the organized share has moved up from 10% to 38%, almost going 4x. And it is projected to again expand to 43% versus the 38% in the next 4 years. And it will outperform the industry growth rate of 16%. It will grow at 20%. So the organized pie has potential to move up from $19 billion to $82 billion by 2028 at a 20% CAGR. But why this shift happens, or why there is a push for the consumers to spend the branded items or the purchase from jewelries from the branded players? So when we studied this consumer behavior, we found out three key parameters which play the crucial role, or the three key factors. The first was the quality and transparency which is offered by the organized retailer, which is unmatchable versus the unorganized roadside shop. Second is the multiple variety, or you can say the multiple designs are available in a customized format under the single roof. And third was the local taste or the regional preference. Maybe the western part of India has little bit different taste, north has little bit different, southern part has different taste, and east has again different taste due to the regional preferences. And also there will be a connect to the global design. So all this comes under one roof when a consumer enters or goes to the, let's say, the organized store, or let's say the branded store. So these are the three themes, these are the three factors which is pushing the shift from unorganized to organized. So in a nutshell, again, jewelry has a potential to grow at around 15 to 16% growth rate. And if one is able to identify some of the themes which can handsomely grow more than 20% growth rate for the next 4 to 5 years, so it can lead to healthy wealth creation. In our portfolios, typically in the one of the portfolio which is on the flexi cap space, and other portfolio is in the small and mid cap space. So we have onboarded some of the themes, particularly from both sides, which is the fashion, retail, and jewelry. And if recently they posted the numbers, so both the numbers were very optimistic, and it was robust. The growth was more than 50% for one of the fashion retail company that we onboarded, and the jewelry company which posted yesterday evening, the growth rate was more than 25%. So we are seeing healthy Q1 results or the Q1 preview from the both sides. So these are the two space or the two sub-segments which we particularly like from the consumer discretionary side. Now we will move towards the third thing, which is the electronic manufacturing space. So if we look at the current size in terms of consumer durable market in India, so it's around 3.3 lakh crore, and it is projected to move towards a 5.5 lakh crore at a rate of around 14 to 15% growth rate. And if we have to divide, let's say, the consumer durable market, so it has multiple segments like color TV, refrigerators, mobile, washing machine, AC, PC, and so what we did was, so we plotted the category penetration versus the developed economy. For example, if you look at the color TV, so India has penetration of around 50% versus if we look at the, let's say, US, which has around more than 90% penetration, or Germany or Australia. So all of them, or China, even China has more than 90% penetration. Similarly, if we compare refrigerator, mobile, washing machine, AC has the lowest, and again the personal computer, which is a PC, has again the lowest penetration. But typically on the householding side, we are focused on the four things, which is color TV, refrigerator, washing machine, and AC, which has a very low penetration and a huge scope to expand and reach to the global average of, let's say, 90% in the next 1 or 1.5 decade, maybe 10 to 15 years. We are expecting it to reach around 80%. So this penetration will go up with the rising disposable income, and government is also pushing the electronic manufacturing space. They have announced PLI scheme. Government has already outlined the capital outlay of around 1.46 lakh crore, and which has resulted into the 12.5 lakh crore sales and 9.5 lakh direct and indirect job creation. So there is a natural tailwind from the government side, and the industry growth is around 14 to 15%. So we think like this growth rate is quite predictable, and any player with the reasonable execution and order book pipeline can even compound the revenue or the top line and the earnings at more than 17 to 18% on the comfortable side. Only catch in this space is the high valuation when you are entering, but that is justified by the higher implied growth rate of, let's say, 30-40% for the next 3-4 years before they start to mature. So anyone wants to play this thing has to be cautious when they enter into the particular valuation parameter into particular player in this EMS side. Now we'll move to the next theme. So next space is healthcare. So we all have seen the COVID time, like there were panic during the wave 1, 2, and 3, and there were a lot of loopholes which were found out in the Indian healthcare system. And strong healthcare manufacturing, or let's say the infra, is mandatory, or let's say you can call it a basic necessity for any developed economy. And as we are progressing toward becoming more developed nation, eventually reaching, let's say, $5,000 GDP per capita mark, so the need of healthcare system is there, and WHO mandates to have at least 3 beds per thousand population. And if you look at the current beds in India, it's only 19 lakhs, which is 1.3 beds per thousand people. On the left side, we have compared it with the global countries like UK has 2.5, US has 2.9, France, Russia has around 5.9, 7.9, and South Korea and Japan, which are considered typically more developed countries in terms of population, they have 13 and 12.4 beds per thousand people. And if you look at our Indian bifurcation, so we have around 25,000 hospitals in the government side, 43,000 in private side. Beds are almost 7 lakh in public, and 12 lakhs almost in private. So 19 lakh beds in last 78 years. So we have a huge work to do to strengthen our healthcare system. And we think like if we have to reach, let's say, 3 beds per thousand population mark, we need to add 24 lakh beds in next 2 decades. If we look at the industry estimates, so people or the industry veterans are considering like the at least the bed penetration to reach 3 bed mark should at least take 2 years or 2 decades. So it's a multi-decadal theme to play around. One thing to keep in mind whenever we are, let's say, picking some business in healthcare side, so go with the strongest one. So typically what we have seen in this space, the ability to increase the ARPOB, or the, in simpler term, the average revenue per occupied bed. So the ability of the branded firm is high. So whichever company can push the ARPOB rate by 10%, or let's say 8 to 10% per year, and they can add new beds, let's say 10% over a year, so they can generate 18 to 20% growth rate on the comfortable side. So we have also identified a couple of businesses on the hospital space in our portfolios, and we remain confident that they will be able to deliver at least 18 to 20% growth rate with combination of, let's say, the room rent hike, which is the average rate per occupied bed, average revenue per occupied bed, and the second will be the bed addition. So this is again a quite solid theme, which is the fourth one. And the last two themes we will move to the next slide. Yeah. So the fifth theme is aviation. So if you look at the current, let's say the passenger traffic in India, so it's around 24 crore to 42 million. And if you bifurcate in between the domestic and the international side, the domestic around 16.4 crore, 78 million. So almost 70% is domestic and 30% is international. And what we have done, we have compared it with the global metric. So there is a particular key metric which showcases where you are in terms of aviation industry in the growth trajectory. Please move to the next one. So in this metric, what we have done, we have compared the seats per capita metric versus the developed average. So on the first chart, we can see on the domestic side, India is 0.13 seats per capita versus the, if we look at the, let's say, developed economies like US, which has 3.09, and some of the comparative peers like China has around 0.59. So we are 20% or let's say 1/5 size of China, and we have 1/24 penetration versus the US. So we have a 24x room to move when we actually become a developed economy. So there will be the huge, let's say, expansion in the seats per capita. On international side, it's way low. It's around 0.06 seats per capita, which is very low in terms of, let's say, we compare with the USA or the UK side, where the expansion is almost 15x or 74x. In the next 2 to 3 decades, we are expecting like this bridge should gap up, and as government is pushing for the new airports, so we are expecting, we have currently 140, 149 or 150 airports as of now. We speak 2025 March, and it is expected to go up to around 220 airports by 2030. And the passenger traffic, which was captured in the earlier chart, which was around 24 crore, it is going to double to 51 crore by 2030. So from this chart and the current traffic growth, we can project like we are in very early stage of aviation industry in terms of India. And as the rising income goes up and the disposable income goes up, so we'll see the accelerated push, and the aviation industry can handsomely deliver around 15 to 16% growth, again on the predictable side and also on the large base side. So these themes also remain our favorite among the various themes. And the last will be the renewable energy. So government of India in 2023, they have come up with a very strong plan. So currently India is going under the energy transition. So currently we have around 220 gigawatt of renewable energy. So in last 15 years, we were able to add this much capacity. But government thought if we have to actually become, let's say, 50% non-renewable energy and 50% renewable energy country, so we will have to accelerate our investment into the renewable space. And government came up with the 45 gigawatt addition every year for the next 6 years till 2030 and reach 500 gigawatt. So some of the large energy sources will be like solar, wind, and hydro. Small ones will be like biomass and green hydrogen. So these are not meaningful, so we have not captured it over here. But the solar, which is around 105, will be the largest beneficiary. It will go up around 280 gigawatt. Wind, which is 47, will almost double to 100, and hydro, which is 46, will move to 70 gigawatt. So government is very keen, and they have come up with a very aggressive pipeline of around 45 gigawatt per every year for the next 6 years. So we think like renewable energy has a very key space if we have to identify future multi-baggers or the future themes that can create huge wealth from the next 5-year perspective. So these are the 6 themes that we have identified based on the macro analysis and also the fundamental analysis which we have conducted. And in our opinion, like there will be these 6 themes will probably post higher growth rate versus the industry, and also it will outperform in terms of earnings growth versus the Sensex or Nifty 500 earnings growth, which is projected around 14 to 15% for next 5 years, and also the small and mid cap space, which is around 16 to 17% earnings growth mark. And of course, we recognize like this is not a short journey. It will be a little bit longer journey. It can happen like there will be delay of around 1-2 years, so that the actual unlocking may happen to 5 or 6 year. But this journey will be definitely a rewarding one. Of course, it can be bumpy with the short-term volatility because of various reasons like global issues or some kind of inflation risk or the demand or supply side issues. But if one wants to say, if one is able to ride through the volatility, we think like the current themes which we have discussed can handsomely generate around 18 to 19% kind of earnings growth rate with the healthy valuation upside as well. So with this, we would like to conclude the webinar.